predominantly trading 3 contracts. We've done $4,500, $4,600 so far, just scalping 3 lots. So it's quite a good profit trading oil and gold. We've shown most of the trades that we've taken this morning, and we've taken screenshots of them. So we can show most of the trades we have had this morning, but you get the basic idea. If you can't spot what the trade is, you shouldn't be doing a trade. It's as simple as that. It's a fast money piece of evidence that we've got to try and trade with. Now looking at the relationship on the gold markets, what we're looking for is that value divergence, which comes from 2 things. Number 1, the background and the foreground. The idea of spotting some value into a key level, for example here, recognizing that value divergence into that key reference just by doing the same as what you've done in a normal chart, finding the value divergence, and then getting into the idea, well, there's never going to be a buy trade in any of these areas. There's never going to be a sell trade in any of these areas. We've got to be able to eliminate one side of the deal, right? We've always got to try and eliminate one side of the deal. And by doing that, we obviously look at other things. We start looking into some of these areas. Now, these trades can last for 1 minute, they can last for 5 minutes, they can last for an hour. The idea is you don't know what it's going to last for, so you've got to just trade them. You don't know if it's going to be the big swing of the day. You don't know if it's going to be a 5-tick swing. You don't know if it's going to be a 10-tick swing before you get into the trade, because what happens next determines how long you stick around, right? So the idea is you're always looking, you're always hunting, you're always trying to figure how long this trade is going to last for. As you move into the other spreads, you can start to spot that spread actually does stand out into those areas as well. Look, so you can see the same kind of trade in the same area right there. Now, obviously, that idea of getting involved in that trade and you start looking for it, you say, well, it should be a sell. And obviously, when you look at gold at that stage, you can see it was a sell, but it lasted for 4 minutes and it never went anywhere. But probability-wise, that's okay. But the reason why I'm highlighting this one is because of that concept of making sure you get your price and no other price at all. And if you got your price, in other words, if you paid 81 for that trade, it did drop down to a low price of 80.5. There's no way you would have lost money in that trade. But if you paid 80.5 for that trade, there's no way you'd have made money on that trade. Massive difference, right? If you paid 81, you couldn't have lost. If you paid 80.5, you couldn't have won. The difference is just 5 ticks. So in other words, that's how critical it is getting the price that you want to get and not paying the price that the market wants to give you. If you don't get the price you want to get, you don't take a trade, you walk away from the deal. Scalping is about getting the price you want to get it at and nothing else, nothing else. And that's all you've got to try and do as a scalper. When you see value setting up, you see, for example, an increase in volume on that red line going up against a blue line that's now going down. First time it's happened on that whole swing. And you look at that and say, right, there's my buy trade. You check it against the other ones and you spot to see whether there's any opportunity to buy the red line. There is. So now you're saying to yourself, well, this is a definite sell opportunity, 100% certain. I'm going to sell that. Not 100% certain you're going to get filled on it, but 100% certain I'm going to sell it. Buy it. I've got it back to front, guys. I was looking at oil. 100% certain you're going to buy it. Remember, if you're selling the pink line, you're buying the candles. If you're buying the red line, you're buying the candles. The blue-red line is the positive correlation. The pink-blue line is the negative correlation. So you have them on the charts at the same time, if you want to have them on the charts. But that's what you've got to try and make sure that you keep yourself up to date with your screens. And you can see if you did buy that and you got filled at 79.6, you can see that you've traded 81.3. It's not a bad little trade. It's not quite $200, but it's not a bad little outcome for 2 or 3 minutes as a scalper. You know, that little trade there, a 5-lot trade gives you $1,000 in 2 minutes right there. $1,000. The last trade, scratch trade. 5 ticks in a scratch. Maybe you made $40 on a scratch. Maybe you just simply scratched it. But this trade, $200, so $1,000 potentially on that trade. And if you get $1,000, there's nothing wrong with that, is there? Nothing wrong with that at all. But the point is that when you work your way through, so for example, if we go from gold and then we go into oil, it's exactly the same storylines. It's exactly the same storylines as we go into oil. When we're looking at trying to figure out whether we should or whether we shouldn't, it's, as we talked about last week, it's about eliminating one side of the deal, isn't it? It's about being able to look at the various elements and saying, right, let's get into the Brent spreads. Let's start with the Brent spreads. Let's start with the crack spread. It doesn't make any difference where you start, so long as you do them all and have a look. And if we're obviously looking at the crack spreads or the Brent spreads, we want to work our way through the processes. Starting with the Brent spreads, the crack spreads, what we're looking to try and do is, of course, buy and sell the black line. So there's two trades that stand out there in terms of buying and selling the black line. There's one setting up right now. So that's obviously something you're going to start investigating, the possibility that there is a scalp setting up right now and it's only going to be a buy trade on oil. So you're obviously going to be starting to investigate that. You're watching for a bid coming in, for example, for the scalp to trickle away. You're waiting for a big lean. We've just actually had a big volume lean right there. It's right on the 76 wholesale, by the way, so that's obviously where the challenge is. Right on the 76 wholesale. I have taken the buy trade whilst I've been chatting about it. I didn't get the price I was wanting because I was actually just flashing up the screens at the time. I was just about to start talking about it. But I'll take a screenshot. I'll show you that we did get the trade that we were literally just talking about right there. And I have already got some profits out of it, and I've already put a stop at break even. So it's that easy. It's that easy. There's a trade there. You agree? Is that a simple trade? Well, not at that price. I mean, I did overpay this time. I mean, I can agree with anybody that asks. I overpaid with that trade. I should have been somewhere in here. I should have been somewhere in here. I wasn't. I was here because I just started talking about it when it showed up. So obviously I was a little bit behind the curve by probably 1 or 2 ticks. So I'm a little bit disappointed in my fill. But that's an absolute no-brainer buy with that big lean behind us. I needed to get a little bit better than what I got, but you see when you still get a good trade and I haven't massively overpaid, I've still got away with it. Now, you know, obviously trading size, that's not acceptable. If I was trading size on this trade, that would not be acceptable to me. But you can see that there was a bid coming in the book at the time. You can see that that trade's gone on and done some pretty good business now on a little 2 lot. Now we'd put in 3 contracts to start with. We've taken profits on one of them. And you can see there's the trade now as it stands. You can see it's already banked some money, and it's $220 in profit on a 2 lot, just literally as we were talking about it. I said it was going to be a buy trade, so we found it and we traded it. High probability trade, right? And you can spot how high the probability trade is right there. So we got that deal done. We saw it. The big volume came in right there. Black line, red line divergence is huge. And there's no question in my mind that that's going to be a buy trade, right? There's no question in my mind that's going to be a buy trade. But if we don't get a bid, we don't take a deal. So obviously we got the buy trade on. We've made another winning trade right there live in the room, even though my price was perhaps realistically 2 ticks out of the money that I should have got on that trade. Now, obviously, as you go through that, the only trade I could have taken was a buy, so it doesn't matter what any other value line was telling me. This would have negated it if it was anything other than a buy anyway. So I can start with one line. You know what I mean? So you might get a buy, you might have got a sell on another indicator, but it would never have allowed you to take the sell based on what this was doing. So there would be no point in having to have all the indicators on at the same time. You only need one. And then when a buy triggers, what are you going to do? Well, at that stage, obviously, you want to make sure you quickly value the markets in terms of the other elements. So if I'm going to buy, I want to make sure that this market's bullish. This is the euro dollar, of course. The euro dollar is bullish, so that's good news. We're in good shape to buy that bottom edge oil, correct? If we're buying, I want to preferably see gas prices going up. Gas prices were going up, so that's good news for gas, right? That's good news for oil. That idea that the oil gas price divergence was starting to sweep wider is good news for oil. So that was a really, really big bonus for that buy trade opportunity, correct? And then, of course, if you want to add the other spreads, we've obviously got the oil Brent. We've got the oil Brent spreads. If you want to work your way through the oil Brents, we've got the crude complex spreads there. And obviously the trade is whether you're buying or selling the blue line back towards the purple line at any point. And you can see at that stage there, you are buying the blue line. The purple line's actually completely flat. It is 100% definitely a buy trade. But you've got to do that whilst that 122 lot is printing at 76 evens so that you're getting the price you want to be getting, right? There's no point in doing it at the speed we've just done it, because by then the price is obviously already gone. So you've got to find a way of being able to get through that processing of information as quickly as you can. In other words, you're trying to verify that the trade exists before you do any other business. So you're looking for that black line, red line, blue line combination, and sometimes that just looks like a jumbled mess, and you can't really see any opportunities on it. Well, that means that you're probably going to have to split your charts up a little bit. And that's not as difficult as you might think, is it? I mean, you've got panels that you can use elsewhere on the screens, guys, right? You've got panels that you can use elsewhere. So we've got the bottom panel, we've got, for example, the calendar spread, but you don't really use the calendar spread much, do you? So you can always take the calendar spread off the charts for a second, and you can drag in either the crack spread or the other spreads, so that you can separate the charts out without getting bombarded with knowledge and information at that point, right? So if I wanted to separate them out, I could bring down the Brent WTI spreads into the bottom panel, so that I can see clearly whether they're diverging at the same time as the crack spreads are diverging, yes? So that makes things just that little bit easier, perhaps, for somebody to recognize. Now, as I said before, whether that's the kind of thing you want to be doing or not, that's up to you. It's a choice you make. But obviously, if I was to take this off this chart and just drag it down into this chart, then of course that becomes something that you can now see separate, setting up on that bottom panel, so that when you put the crack spreads back into play, now you're obviously being able to see things maybe just that a little bit clearer, a little bit faster, a little bit, well, you see it. So you're trading the black over the blue there, so long as the blue is at one extreme and the black is at another extreme. So for example there, the black's at an extreme, the blue's at an extreme there. So that's obviously going to be the same trade. It's another buy opportunity. So those two buy opportunities, well, that oil price went up and that oil prices went up beautifully, right? So anytime you see these, when blue is below, you're obviously already starting to look for that. You're already saying to yourself, well, a little bit of a divergence now. I might be able to get some business done into a new low price. Well, you got the new low price. You got the big surge of volume that you were looking for. You got the perfect buy trade. Setting yourself up in position to do that trade, well, that's all you're trying to do. You've got to have your charts in such a way that the read is quick, the read is clean, and the read is clear. Now, what that can mean is that if obviously the negative correlation is in this chart and the positive is here, you can always add in one of the other positives to the bottom chart, like the euro dollar or natural gas prices, for example. You can add it to the bottom panel, so that you can always have that extra outside market running simultaneously. So again, you don't have to go back through all the various lines to check that everything lines up perfectly. So when you've got natural gas, you can obviously leave it on this chart, or you can put it in this chart so that it's a positive correlation to what you're seeing. So you could bring the natural gas price into that chart, and so long as the natural gas price agrees that it's on the opposite side to the blue line, you're in pretty good shape, or the euro dollar, or the whatever, then you're in good shape for the deal. In this case, that's as good a trade as you're likely to see, right? Blue line bottom, gas very bullish, and obviously the spreads coming in, black line top, and all the spreads very bearish. That gives you a brilliant opportunity to scalp into some buys at the bottom edges. What a wonderful way to make a living on the oil markets. It's fast, it's clear, very, very obvious, and obviously what you're trying to do is make sure that it ties in, with what you're thinking about elsewhere. So when you see the gas market in this buy trade here was slightly diverging, and obviously that's okay. The blue line is definitely at the bottom edge. The black line is definitely at the top edge here. This is not probably as good a buy trade, but it's still a good buy trade, and it made a lot of money. It made a lot of money. And again, that is a benchmark, without question, Theo. That is 100% a benchmark, because it didn't just have, now take a look at the order book. We've got enough of a clip there. It shows what the order book was doing as well. So you can see the limits. So the limits turned on this candle here. Do you see that? So the actual book went bullish on this red candle. So there is absolutely no question about that trade. There's nothing. If you don't get that trade, you don't get any trade, right? If you don't get that trade there, you don't get any trade on oil. That's as good as it gets, guys. I'm sorry, but if you don't get that trade, there's no point in you trading oil, because that is as good as it gets. You can't get any better than that. There's nothing else I can add to your charts that's going to make that any better. So if that's still not good enough for you, you won't find anything. You will literally not find anything better. So Theo is 100% right. That is a 100% benchmark. It's one of the best trades